when you're buying mutual funds, there are different share classes. Now, some mutual funds are considered no load, but the majority of them are not biblically responsible. So when you buy, and this is specific to Timothy, or not specific to Timothy, but it's applies to every mutual fund out there that have loaded shares. What that means is there are costs to buying, holding, and sometimes selling mutual funds. And the way that you want to do it, B shares are really no longer a thing. That's where an A share is where you pay an upfront commission to purchase a mutual fund. Now, mutual funds are long-term investments. You shouldn't get in them to try to trade them or to, hey, I'm just going to try this for a couple of years and see what happens. B shares had a deferred sales charge. You didn't pay anything to get in them, but if you got out before anywhere between 5 to 8 years, then you had to pay to get out of them. A C share has no upfront sales charge to get into them, but if you don't stay in them for 12 or 13 months, then you have to pay 1% to get out. Mutual funds, all mutual funds, whether they're loaded or unloaded, no loaded, they have operating expenses. That's what goes to pay the fund managers, because when you buy a mutual fund, you're hiring a management team to pick and choose the investments in that fund for you. You're not picking individual stocks. So they've got to get paid. There's transaction costs inside the mutual funds. There's fees for operating the fund company overall, sending out statements, all of those things. So all of those things are, you can find the ratio, the expense ratio inside the prospectus for any mutual fund. So you got to know that that's a cost to hold too. Now, when you're building your portfolio with the Timothy funds, I'm a proponent of using A shares, paying the upfront sales charge, because if you hold it over at least an 8 to 10 year period, the cost, and you spread out that cost over that long term, it's going to be very, very low. So it's a great efficient way to own mutual funds. Now, there are those out there that would say, well, if it's short term, buy the C share because it doesn't cost you anything to get in, doesn't cost you anything to get out, but the internal expenses on a C share are higher. I would say if this is a short-term decision, you shouldn't even be looking at mutual funds. So stick with the A shares.